record this. We will post this up on our website at a later date, and it will be available to email to you afterwards as well. So if you would like to simply send us an email after the fact, we can always do that. Now, a couple of quick housekeeping items. If you have a copy of my personal financial landscape in front of you, ideally listening to this webinar, I would like you to have a pen and paper to write down some notes. We are going to make this the basis of future webinars. So just to give you an idea of how this is going to roll and how it works, what I'm going to be doing is I'm going to be going through, I'm going to be walking through your personal financial landscape as a foundation for future webinars, because this webinar series is about investing. It could be investing in real estate, it could be investing in stock markets, it could be investing in private equity. It doesn't matter what it is you're thinking of investing in, or what you think you should be investing in, or what somebody's trying to convince you to invest in. What this is really about is getting a good core foundation as to what's important to you, where you are personally, financially today, where you see yourself in the future, and what your plan is to get there. Then and only then, once we create clarity as to what the end result needs to be, why you're buying, whether it's real estate or any other investment, before you can make a decision as to whether this particular investment is a good investment for you or not, you need clarity as to where you are today and what result you need from any particular investment. And on that note, that's why I always like to start with the sense of where, for me, it's the mission statement. My mission statement, I sat down way back in 2008 with a personal coach, and I analyzed why do I do what I do? What's important to me personally? And to me, at the end of it, my background's a teacher, so for me, it's to teach, coach, and empower individuals to accomplish goals that will positively impact the world. Sounds like a bold statement, right? Well, here's where I'm coming from with that. I believe absolutely, fundamentally, that if you, the person listening to this right now, if you could get total control of your personal financial picture, and that empowers you or allows you to accomplish your personal financial goal, I believe that you will have a positive influence on 100 people within your sphere of influence. Does that make sense? In other words, if you have successfully accomplished your personal financial goal, you by definition will have a positive impact on a generation before you and probably two to follow. And generally speaking, you're going to have a positive impact on roughly around 100 people within your sphere of influence, people that you touch and impact in the day-to-day life. So for me, if I can help 10,000 people over the course of my lifetime accomplish their personal financial goals, indirectly multiply that by 100, well, ideally on my deathbed, I can look back and say that in one way, shape, or form, I've touched or impacted over 1 million people in this world. So that's kind of a personal goal of mine, and I wanted to share that with you because that's kind of where I come from, and that's what kind of the foundation of all the teachings and concepts that I come up and some of the things I'm going to be sharing with you tonight. So I want you to understand a little bit about me and where that comes from. And on that note, I always like to share the why. Why do you do what you do? I know I'm sitting here on a Tuesday night in Vancouver, and it's cold and wet and miserable as we approach the holiday season, and immediately my brain goes to, man, I sure would love to be on a beach somewhere where it's nice, warmer, much warmer weather, and I'm sure everybody listening to this, and somewhere across Canada, you're probably thinking the same at one point or another today. But I share this picture here of my daughter, and for those of you who don't recognize the baseball park there, the green wall behind her, that's Fenway Park in Boston. I grew up a huge Boston fan, Boston Bruins, Boston Red Sox, and one of my ultimate places on earth to spend time with on a beautiful afternoon would be Fenway Park in Boston. And if I can spend a day in Fenway Park with my wife and kids, to me that's one of the most awesome memories that I'm going to be creating, and that's one of the most awesome moments for me. So when I look at this picture, I throw this picture up because for me, I look at that and it brings joy and happiness to my heart because that's a place that means something to me. It represents family. It represents something I love, being A, my daughter, and B, Fenway Park, the Red Sox, and a sunny afternoon with a Fenway Frank and a cold one in your hand. So that's what that's what does it for me. So one of the things I want to talk about before we even get into talking about investments is I'm going to challenge each and every one of you to dig a little deeper and ask yourself, what's your why? What drives you? You know, maybe, I know for my wife loves the idea, and we're going to be doing this shortly, a walking wine tour through Tuscany. I don't know if that resonates with anybody out there, but, you know, being able to have the time and money to be able to take off and do a walking tour through Tuscany. You know, and again, maybe it's charity. Some of you are very driven by personal needs and goals to provide charity. It could also be caring for loved ones. I know a lot of people online, we look at the baby boomers now between 50 and 70 with aging parents who are at a stage where we now have to turn around and take care of them. So what is it for you? Maybe it's just coming up with a plan for your retirement. Regardless of what it is, the first and foremost, I challenge everybody on the line to think about what it is, what's your reason, what's really important to you. And once you get clarity around that, then you have to turn around and create a financial plan. So once you have the clarity around what your reason is, what your why is, the next step is to come up with a financial plan to make it happen. Now, here's where it gets interesting, because I talk to a lot of people, and, you know, for the majority of people listening to this, you know me as a mortgage broker. My background is, you know, 20 years in the mortgage and finance industry. I've written a couple of books with Don Campbell and worked with the Real Estate Investment Network, amongst other entities, most predominantly working with real estate investors over those years. But what's really interesting is I found that real estate's fantastic, and certainly I'm a firm believer and proponent of real estate, but it's not everything. There's other components as well. If you talk to the typical average financial planner out there, some of you have had this experience. When you talk to a financial planner, it's often challenging to get a financial planner to suggest that you invest in real estate. They will alternatively are going to suggest products that they represent, i.e. stocks, bonds, mutual funds. So a lot of times when I'm talking to people who have not previously been exposed to real estate, one of the questions I often ask is, what role could or should real estate play in your financial plan? That doesn't mean you have to be all or nothing, but it is a very important question. You know, one of the most common or biggest themes I'm seeing out there in the market as I travel and talk to people, and I visit real estate offices and I talk to individuals, whether it be realtors or the clients, two predominant themes I hear out in the market are, number one, do I have enough money to retire? You know, if you could just eavesdrop on the average typical Canadian kitchen table conversation for anybody who's between 40 and 60, it's going to be one of two conversations. Either A, hey, do we have enough money to retire comfortably in the lifestyle that we become accustomed to? And secondly, will our children ever be able to afford to live in this city? I know there's people on the line here from all across Canada, and, you know, price points in different markets vary, but I can tell you this much. If you live in Vancouver right now, that is certainly a question on your mind, whether or not your children are ever going to be able to retire in this city in particular. So, you know, having said that, one of the questions to ask is, what role could or should real estate play in that? But then what's interesting, like I said earlier, we have a situation where you as an individual are often faced with trying to determine or decide for yourself how I should invest my money, where I should invest my money, where am I going to get the best bang for my buck, so to speak, and more important than anything, who should I talk to? Who's going to give me the most unbiased advice out there? And I like to, one of the things you're going to see tonight throughout my presentation is a lot of analogies. I love talking analogies. One of the analogies I use over and over again is, an example or analogy where someone were to come up to me and say, ask me for advice. Let me put it this way. Imagine I came to you and I sat down with you and I said, hey, Joe, where are you planning to go on vacation? And you said, you know what? We haven't decided if we're going to take a car, a boat, or a plane. I thought, well, that was an interesting answer, because the question was, where are you going? And Joe says, well, the thing is, we're really caught up in this car because I love this vehicle, and it turns out I got to deal with the owner, the guy's selling it to me, and he's offering me half price. So Joe's really focused in on the car because it's half price. It's a hell of a deal. Here's the challenge. We dig a little deeper, and we find out that Joe's destination, well, it's Hawaii. His holiday destination is Hawaii, but he's really fixated on getting half price on a car. What's the point of the story? Well, you could probably guess. Doesn't matter how good a deal Joe gets on the car, it's not going to get him to Hawaii. So here's what I mean by that analogy. Here's what that story really means. The challenge with the majority of people out there is they're lacking clarity as to what the holiday destination is. They're lacking clarity as to what their financial destination is. And the problem is this: in the absence of clarity, you can get sold anything. You know what? Someone could convince you that you should buy that car because it's half price, even though you're trying to get to Hawaii. Well, it doesn't matter how good a deal you got in the car. It'll never get you to Hawaii. And that is the truth with a lot of investment products out there. And the challenge is, the problem is that the person selling you is probably working off a commission. It's not their fault. I'm not saying they're bad people. It's just that the guy who sells cars only sells cars. So guess what? He's going to tell you all the features and benefits of a car. It's up to you to determine whether a car is going to help you get to your destination. It's up to you to determine what type of real estate will help you accomplish the end result. What type of stock will help you get to the end result. Maybe you should get into some private equity opportunities, some limited partnerships. Should you invest in the United States? Should you invest in Canada? All these questions that you get inundated with and bombarded with could be very, very challenging. And, of course, they're going to be even more complicated if you lack the clarity as to what end result you're looking for. If you don't know where it is you're going, how on earth are you going to determine what's a good question versus, or what's a good investment versus a poor investment? You know, and that brings us to talking about whether you should be investing in real estate or stocks. Yeah, the age-old conversation. You know, you talk to financial planners out there, and of course, again, this is not a. I want to be really clear. I'm not slagging financial planners in any way, shape, or form. The truth is, I can slag mortgage brokers and realtors just as much, because here's what I've personally discovered, and you can tell me if you agree or not. What I've discovered, with the rare and odd exception of the typical financial planner or person who's giving you advice on stocks and bonds and mutual funds, will seldom turn around and say, well, you know what, you should probably take $100,000 out of the stock market here and move it over and buy some real estate, because that's probably going to be a better return for you. Well, you sometimes fee-only financial planners will do that, or some very successful, some good financial planners will do that. But the truth of the matter is, typically anybody who gives you that advice is taking money out of their own pocket and taking money off their own table, so to speak, and giving you advice to allocate it elsewhere, even though that may or may not be the best thing for you. The flip side is, very rarely will a realtor suggest, have you ever considered not buying real estate and maybe investing in some stocks? I know a really good I know a really good stockbroker. I know a really good financial planner who could help you invest this money and get a really good return. Well, I've never heard a realtor give that advice. And I guess the point I'm making here is the challenge is that people quite often indirectly, well, and it doesn't mean they're ill-intentioned, but quite often people will give advice based on how they're compensated. You know, it's kind of like a doctor who is driven by the pharmaceutical Western medicine thought process very seldom will tell you to go to a naturopath, even though it's very seldom. Well, let's put it this way, very seldom that a Western doctor will suggest that you're better served or better off going to a naturopath. And the thing is, they're often hardwired to think that way. Their training is that way. All the education has led them to think that way. So again, it doesn't mean that these people don't have your best interest at heart, or they're not trying their hardest to do the best for you. It just means they have inherent biases. Now, the reason I mention that is because I truly believe the best solution is a hybrid. And one of the reasons I do what I do is because I found that it was very difficult to find an unbiased perspective that can give you the hybrid of both. And that's really what we're going to try to do here tonight, is help you understand. And that's the purpose and intention, by the way, of the entire webinar series. I'm going to be talking about the stock market. I'm going to be talking about investment opportunities in stocks and bonds and portfolio management, et cetera. We're going to be talking about real estate. We're going to be talking about private equity opportunities. I'm not going to sit here and tell you you should do this or should do that. What I am going to do is try to lay things out and help you come to the best solution of creating a hybrid solution based on your goals, because at the end of the day, everything should be goal-based. And I refer to that as a holistic financial plan. And a holistic financial plan takes into consideration everything and then gives you options. You know, if you look at a football analogy, let's say I'm the quarterback. Well, if I'm the quarterback, I'm not going to step back, throw the ball, run down the field, and catch it myself. I'm going to throw to a wide receiver. But sometimes I'm going to hand the ball off to the running back, and other times I'm going to throw a slant pass to the slot back. The point is, you can never win a game by giving the ball to one person every time. Heck, the Seattle Seahawks learned that. But the point being is that you're going to have to integrate all the players on the board at the right time. A good quarterback is going to know when to give the ball to which player at which time and make the right call. Your job is to figure out what touchdown means to you. How would you define what a touchdown means to you, and how then once you define that, then you need to get the right quarterback that can integrate the right players on the field and know when to use them and in what order to use them. So here's an example of one of the things that I like to suggest that would be kind of a typical portfolio mix. Now, I want to emphasize that a majority of the people on this call may or may not be you have a background of working with me in the past strictly in real estate, so these numbers might be skewed if you are a real estate investor. But if I'm looking at the average general public, the majority of the general public have their money, I'm talking about their savings and investments, tied up. They hand it over to a financial planner or a financial advisor at a bank, and typically that's going to be 80 to 90% in the equities and bonds market. Another approach would be like this, what you see on the screen here. Imagine if you could have a nice diversified portfolio where 10 to 30% of your net worth was invested in real estate investments outside of the principal residence, and maybe 50 to 80% of your RRSPs would be into the equities and bond market, the public markets. But you should also take a look at private equity. Private equity is defined as investments that are not are what we call illiquid, means they're not being traded on any stock exchange. Sometimes that's where you can get the biggest hit, the biggest bang for your buck, the biggest home run potential, but, and I want to emphasize this, it's also the riskiest because it's illiquid, it's not being traded, and they may never make it. They could go bust. Therefore, you want to maximize and never ever have more than 10 to 20% of your money in that type of vehicle. So a lot of people have asked me recently, Peter, I noticed your business model changes. Are you no longer doing mortgages, or are you now working on wealth management and providing solutions only in the equities market? And the answer is no. The answer is we have the Peter Kinch mortgage team. So if the conversation revolves around real estate and we determine that, you know what, the best thing for you is real estate, fantastic. We can do what we've always done. What I would think is, and I truly believe, is the best mortgage team in the country for helping you develop a real estate portfolio. Having said that, I'm also licensed now with TriView Capital as the Vice President of TriView Capital, and TriView Capital is a private equity specialist. I'll touch on that a little bit more later, but we provide a lot of variety of options for investors in the private equity world, and I can help you discern and distinguish between what's right, what's a good investment versus a bad investment, again, based on your needs. And lastly, we have partners with Richardson GMP McIver, Neil McIver from Capital Management, and Lonsdale Portfolios with Newport Private Wealth, one of the best portfolio managers in the country to handle anything in the public markets, be it stocks, bonds, or mutual funds. It's a combination. This is my version of having the running back, the slot back, and the wide receiver for the long bomb. It's the combination of all three of these that's going to help you get the touchdown. And again, the best solution is hybrid. I truly, truly believe that. Therefore, that's what we're going to be looking at as we progress through this webinar series. We're going to be looking at all the different components available to you, and I really want to engage you to be proactive in helping work, taking a look at this and saying, asking questions. Feel free to email me questions and type in your questions in the question bar there, because I believe that it's going to be a combination of all these things that's going to help you accomplish your goal. But before you can look at any of those investments, we do need to look at what your strategy is. Okay, one of the questions that's popped in here from Brent: is that at retirement or before, or does it matter? Brent, if you could just retype your question there. I just want to get some clarity around what you're referencing. Is that what you meant by that? So Brent, just to retype your question with a little more clarity, I'll get to that. In the meantime, following the theme of doing analogies, I also want to suggest that when you look at your retirement picture, the big picture, you want to look at it from the perspective of a chess game. And you don't need to be a chess player to understand this analogy, but the goal and objective of chess is to get checkmate. So I always want to look at this and say, what's your definition of checkmate? When you look at that and say, in my life, what's checkmate for you in your life? And we're going to walk you through an exercise here that will help you define that a little bit. And then if you are playing chess, you always want to think 1 or 2 moves in advance. Chess is a very strategic game, and so is your retirement and your pension planning. So when you think about that, sometimes the easiest move on a board in a chessboard is just to take the pawn in front of you, because it's in front of you, it's there, it's obvious. But taking the pawn doesn't necessarily mean that's the best move for you, because it may open up or expose something at a different part on the board that you hadn't actually seen. So sometimes what you need is a bird's eye perspective to have somebody else look at the board for you and help you analyze where you're exposed, and that if everything you do in life has a cause and effect. So if you make a move in one area of the board, it may expose you in another. So part of what we do when we look at the strategy is making sure that we're thinking 2, 3, 4 moves in advance, so that the moves you make today are always consistent with the end result you're looking to accomplish. So on that note, one of the things we want to look at is 3 things. If I'm sitting down with you across from you, I'm always going to be asking you these 3 questions. Number 1, where are you now? Where are you going? And what's your plan to get there? Where are you now? Where are you going? And what's your plan to get there? And before we do that, just going back to Brent, you were asking about the percentages. Are the percentages that you propose, are they applicable to the day of retirement? Brent's asking about the percentage allocated to real estate, private equity, and the markets. You know what, Brent, that's an excellent question. There's a big difference between how those percentages will be allocated if you're in your 30s as opposed to your 60s. In your 30s, you might take higher risks because, A, you have time to recover if you invest in something that doesn't work, and B, you have a longer time horizon to earn more money to invest. The closer you get to retirement, and once you get to retirement, the shift certainly becomes more a component of asset protection, and we'll talk about that a little later as well. So hopefully that answers your question. In terms of those percentages I laid out there, I think they're more of a guideline, and they have to be customized to each individual as you go along. So as we've been talking about, the real theme that I like to touch on and start with here is the whole concept of, first and foremost, finding out where you are today, where you're going in the future, and what your plan is to get there. So the first step is to see where you're at today. So let's take a personal inventory. Now, hopefully everybody if you registered for the webinar, you got an email with this page. It should look just like this, My Personal Financial Landscape. If you do not have this in front of you, just grab a pen and paper, and then you can write down, make some notes based on what we're going to be talking about, because I'm going to be walking you through this page. Now, if you were sitting across from me right now, this is exactly what we would do. We would walk through this step by step. Now, given the fact that I'm sitting here with a lot of people online, I cannot ask each and every one of you to fill this out and ask, get immediate feedback. So I'm going to walk you through this exercise, and I'm going to just suggest, for the sake of time tonight, what we're going to do is I'm going to go through this and kind of show you what the concepts are. My encouragement to you would be for you, each of you individually, to go back and fill in the blanks, do your own homework, and ask yourself, what are the real answers? So again, for the purpose of tonight, maybe write down some answers, some numbers that you, even if you don't know the exact numbers, ballpark them, and then your homework assignment is to go back and flesh that out to get the actual numbers. So what we're going to do is we're going to start on the left side of that page, which is 2015. At the very top, we talk about lifestyle. It's really not designed to be a fill-in-the-blank thing, but really just to ask yourself and get you thinking about where you are today. How old are you today? How's your spouse? How old are your kids? What are you doing for work? What does life look like for you today? So take a second and just ponder on your current reality. What are you doing for a job? And what your kind of horizon are, or where you are financially. What's your financial picture look like today? Once you've got that kind of visual in your head, the next thing is to ask yourself, what's your current budget? So what do you spend currently in after-tax dollars every month? Again, for a lot of you, you're not really sure exactly what that number is. Some of you know exactly what it is, others don't. So for the purpose of this exercise, if you're writing the answer down, then just ballpark it for today. One of the quick and easy ways you can do this is take your annual income. If you make 60 grand, your spouse makes 40 grand, there's $100,000 a month. Well, I know if I divide $100,000 by 12, that's $8,300 a month. So that would be a before tax number, $8,300. So you can kind of, if you want to put down your before tax number, you can put that down as long as you're consistent with it. Once you've determined how much you're spending every month, then take a look at what your sources are. Again, we're just working down the left side of the page there. What's your monthly income? What's your spouse's monthly income? If you're self-employed, write down the number that you actually bring into your family, not the number that you're showing Revenue Canada, but the net number that you actually pay yourself if you're self-employed. Moving along from there, I'd like you to take stock of your current financial situation. How much money do you have currently in cash, T-bills, GICs, term deposits? Do you have a TFSA? If so, how much money is invested in that? Yeah, some of you know these numbers right off the top of your head. Others have to take a little bit, some time to calculate those. Real estate, what's the total value of real estate, including your principal residence, and what are the mortgages? And last but not least, what do you have in RRSPs? What's your pension plan? Do you have a pension plan? Or any other non-real estate investments outside of your RRSPs? So again, that is everything on the left side of the page. I'm going to pause for 1 minute here and just give you a little bit of time to fill in the blanks a little on the left side. If you haven't already, if you didn't have these numbers ahead of time, I'm going to give you 1 minute here, just a pause from the webinar, and take the time to just jot down some notes and numbers, again, on the left side of the page. I'll be back in 1 minute. Thanks a lot. I'm back now. So if anybody has any questions, there is a question board there. Feel free to write some questions. I know this is an area that often has questions because of clarity, etc. But if not, we can just move on from there. So hopefully by now you got a sense in terms of what your lifestyle is, the budget, how much money you're burning through. I call it the burn rate, because if you're running a company right now, the amount of money you burn through on a monthly basis is called your burn rate, and a household's like that. You know, we all know that we're burning through just to keep the electricity on, pay the bills, and the kids' sports and whatnot. Some of you know that number to a T. Others have no clue, but you know that there's a full range and gauntlet of that. You know what your income sources is. You know what you have in savings, how much you have invested, whether it's in real estate, RSPs, pensions, or non-real estate, non-RSP investments. The idea here is to get a good sense of where things are at for you. Question there is, are income sources supposed to be gross or net? So Liz, answering your question there, if you have a salary, then really, what I'm looking for there is probably, I'm just thinking out loud here, probably best to put net, because, you know, what are you bringing in? What actually hits the household? Obviously, if you have a gross monthly salary, you're going to be paying taxes, etc. The one thing here, if you put the budget, your budget could be before taxes, income sources could be before taxes. But then when you move everything to the right side, as long as you're consistent, if the numbers on the left are before taxes, then we got to make sure the numbers on the right are also before taxes. If we want, so you can pick either one, after tax or before tax, as long as you're consistent throughout. Hopefully that makes sense. Well, now we're going to shift to the right side of the page. The right side of the page, we're going to look to a future date, because remember, it's about where you are, where you're going, and what your plan is to get there. So the one thing we know, 10 years from now, God willing, you'll be 10 years older. The question is, are you going to arrive at that destination on purpose, or are you just going to let the winds of change take you there? So the question really becomes, how do we have, and well, let me put it this way, take a step back. I personally believe that each and every one of you have the ability to be the architect of your own future. I believe you can have more control as to where and how you live 10 years from now than you realize, but that begins with creating clarity as to what you want that to look like. I'm not talking about just coming up with some pie in the sky, well, I want jet billing. That might be your goal or objective, but I mean, honestly, just have a very real heart-to-heart conversation with yourself or with your spouse and say, what do we want this to look like? You know, one of the exercises, I do a workshop, the 5-year action plan workshop. When I used to do that, I would have some of the students in the class go through an exercise where you would creatively visualize a conversation with your future self. It's really powerful if you could just take a second and picture yourself 10, 15, 20 years older than you are today. Write that age down and close your eyes for 1 second and visualize the older version of yourself. See yourself there and ask your future self, how are things going? What kind of lifestyle do we have? Where do we live? What do we do for work? How did it all go? It's an amazingly powerful exercise. I encourage you, not right now, but down the road, after this webinar, take the time to do that, because it'll help you kind of create a visualization of what you subconsciously want for yourself. And really, that's the purpose of this, the right side of the page, is to pick a future projected date. Now, this is going to range. If somebody's sitting here in their 20s, you might have a real difficult time picturing yourself retired in age 60, because that's just way too far off. So you might want to have a goal for where you see yourself at age 30. If you're currently in your 40s, you might want to say, you know what, I work in a job. I know I'm going to retire at a certain date. Therefore, I'm going to pick a 20-year target here, and I'm going to put the year 2035 down as my retirement year, and that's what I'm working towards. Somebody else might have a 10-year target. Whatever it is, each and every one of you are going to have a different time frame for this, because it's going to be different and unique for each and every one of you. So I want to emphasize at this point, and it's very important that we pause, and I say this again and repeat this slowly, because I want you to pick a date in the future that you want to work towards for yourself. Is that a 5-year goal, a 10-year goal, a 15, 20, whatever it is, but write that date down there. Again, for the purpose of this exercise, I'm going to use the year 2025. Okay, and then what I want to do is I'm going to ask you again, how old are you at that age? How old are your kids? That one shocks a lot of people when you sit there and you realize, okay, oh my God, my kids are going to be 21. That's a very interesting exercise in and of itself. And what are you doing for work? Now, here's the real kicker. How much income are you going to need on a monthly basis to live the life that you just visualized? That's really important. So take a minute to do that. Okay, so I just want to, again, helping with some clarity around this, because there are some questions. When I say what kind of income do you need, so let's say that I picture myself 10 years from now and I see myself no longer working full-time in my current employment. How much money, and I've created a visual, a life for myself in the future. Let's say, for example, I see myself retired. Now, it's important, I often will remind people that our definition of retirement will probably be different than our parents' definition of retirement, because we tend to want to live larger. We like a good quality wine. Not that your parents didn't, but being able to take trips to Tuscany and enjoy a good wine or a good steak, whatever it is, it tends to be more expensive than it was in our parents' generation. There used to be the school of thought that you retire, you pay the house off, and the kids move out. Well, you really don't need that much to live off of, because there's no mortgage and there's no kids. Well, for half of us, our kids are probably going to end up back in the basement suite. And we may have the house paid off, but we want to travel more than our parents did. So I caution you to be careful not to discount your future budget too much. Having said that, you also want to temper it with a little bit of realism as well. Now the next thing is to move everything from the left side to the right and ask yourself, what are my projected income sources? So, for example, if I know I'm going to be retiring, and in the year 2025 I will be retired, the question then becomes, do I have a pension? If you're self-employed, this is really important, because clearly if you're self-employed, you're probably going to have zero for pension. And if the company you work for, the business you have, if you're either going to sell it, or if it's a situation where you're going to stop working, then ask yourself, will I have the ability to move into a semi-retired state? Is that what I want? When I created the vision for my future lifestyle, was I still working full-time? Was I working part-time? Was I working at all? This is where you really have a gut check for you and your spouse to say, what are the realistic projections for our income sources outside of investments, by the way? If you're sitting there right now saying, well, I've got 14 properties, they're all going to be paid off free and clear, just put that one on pause. I'm only talking about income from work-related sources, so pensions or other income. So take a look and say, I refer to this as B. B is the amount of revenue that you're projected to be earning on a monthly basis. Remember, prior to this, we talked about A. A is what you want. A is the amount of money that you would like to see coming in on a monthly basis. You feel you need X dollars a month to live the life you want. B is what you're projected to be earning based on pensions or other income sources. The formula then becomes A minus B will identify whether you have a gap or a surplus. So take a second and just subtract B from A to identify whether or not you have a gap. For example, let's say that A for me was $10,000. I would like, in the year 2025, I would like to earn $10,000 a month to maintain and live the lifestyle I've become accustomed to. Now let's assume that for the sake of argument, I have a pension, and my pension is going to bring in $4,000 a month. Well, if that's the case, then I'm going to look and say, well, my gap is $6,000. I'll be earning 10 from, or sorry, my goal, my want is 10,000, but my projected income is only going to be 4 from pensions. That means I'm going to have a $6,000 gap. If that's the case, then I'm going to have to look back at the money I have today, the investments I have, whether that's, again, real estate or stocks or bonds or any other investment. The purpose of those investments now is designed to identify or address the gap, and that's the clarity that you need. So again, you look at everything on the left is where you are today. On the right, we identified a future lifestyle that you want, a budget. Again, I'm going to use my example here and say in the year 2025, I want $10,000 a month. I know that all I'm going to be relying on is a pension. That's going to kick in 4, so I have a gap of $6,000. Once I've identified the gap, I then look back at today's reality, the amount of real estate investment I have or the non-real estate investments that I have, the amount of money I have available to invest, and you know what? The gap drives the bus, and that's critical because now you know what result you need from your investments. You've identified and created clarity as to what your future need is. Now I can look at potential investment options, and every time somebody pitches me an idea, I can sit there and say that, okay, if this is what I need, I know my gap is $6,000 a month, I'm going to analyze whether this investment that somebody's pitching to me makes sense or not. Okay, and that's the filter through which you can basically analyze every investment moving forward. So simple math, simple exercise, but honestly, it's something that very few people do and not often enough. But you have to allow the gap to drive the bus, and and either that investment that you're considering making is going to work or not. Now, once we identified the gap, we then got to go back and analyze our current investments. So you might have investments in real estate or stocks and bonds or a combination, a hybrid, hopefully you do. And the question is, what's your current trajectory? How are your current investments performing? What trajectory are you currently on? And are the current investments sufficient, or will you need more? Do you have, for example, if you own real estate, I could take your real estate today and I could say, okay, well, if the mortgages are all paid off, how much money would you be earning on a monthly basis if every mortgage you had right now was paid off free and clear? Well, take that number, look at the gap, and ask yourself, if every mortgage was paid off free and clear in the next 10 years, would the amount of monthly net income from my real estate investments addressed, and will it address the gap? Will it be sufficient to fulfill the gap? Yes or no? If the answer is yes, well then your 10-year program is really easy. All you need to do is focus on a debt reduction strategy and focus on paying off the mortgages you have, and you will have sufficient income from your real estate to live the life you want to live in the future. If the answer is no, well then you might have to look at additional assets. Also, when you look at this, you can't ignore your RSPs. Because a lot of times, especially if you're part of the real estate investment network or a real estate networking group, the focus is so much on the real estate side that quite often we forget about RSPs. I'll often sit down and say, look at someone's RSPs and say, well, let's project these out as if you're making a 6 to 8% return over the next few years. And again, I just want to reiterate or go over the summary here a bit. Let's say I needed $10,000 a month. My pension was $4,000. Therefore, my gap was $6,000. Okay, we went through that math before. But now I look at this and say, hey, wait a second. I've got some stocks and bonds or private equity. Let's say I had some RSPs, $150,000 in RSPs. Do you realize that if you had consistent compounding at 7% over a period of 10 years, that would equal $300,000. You'd effectively double. If you got a 7% return year over year over 10 years, that would double your investment. So your $150,000 would become $300,000. Again, just using a hypothetical example here. So 10 years later, what would that look like? Imagine I had $300,000 now in my RSPs, and let's just say I threw it into a fund or an investment that got me 6% return. 6% of $300,000 would work out to $1,500 a month. Okay, again, just doing that math again. I focused on getting a 7% return on my RSP over this, consistent return over 10 years. By the way, just as an aside, Warren Buffett was often quoted as saying, the best way to become a millionaire is to develop a good, solid, steady portfolio and get a simple 6 to 8% return consistently year in, year out, compounding, and the results will be far greater than those who shoot for the 20% one year but lose 15 the next. So sometimes on our stocks or RSPs, we get so tied up and caught up on trying to get these home run returns that we have great returns one year but then bad returns next, and the volatility is so great that it minimizes your return over a compounded period. Whereas if you could simply get a 7% return year after year for 10 years, your money would double. And then if you took that money and you took $300,000 times 6%, that would be $18,000 a year. If I divide that by 12, guess what? That's a $1,500 a month revenue income stream. So I take that and I say, well, if I combine my pension and RSP income that I've now projected out, well, now I've added $1,500, so my gap's gone, basically shrunk. Whereas before I had a gap of $6,000 a month. Actually, my math's wrong here. Look at that, bad math. My gap would actually be down to $4,500. So just change that number there to $4,500. Sorry, the 4,000. My math's not off. There's 4,000 plus 1,500 is 5,500. Now I redo my gap. My original number was $10,000. I subtract the $5,500. Now I'm down to the $4,500 gap. So again, don't worry, got distracted there with my own math. The point is this: you have to take a look at that RSP income in addition to future projected real estate income. And or now, if my goal was to take a look at my rents, if my mortgages were all paid off, now I could look at that and say, well, if all my mortgages were paid off and I was able to get this much money from my RSPs, will I now have enough money to address the gap? Yes or no? If the answer is no, you know that you need to add additional assets to the mix. If the answer is, wow, geez, you know what? My math's actually pretty good. I'm currently on task, on target to accomplish my end result. So again, it's either a yes or no answer for you. I just want at this point really emphasize, take a moment and pause, because again, you know, when I'm talking on a webinar like this, I don't get immediate feedback from everybody. So I want to just emphasize one thing and pause, okay? Take a pause and just to reiterate, anyone listening to this right now, you might have a ton of questions. You're not, you know, I might have lost you here. You're not sure exactly what I meant by this or that. Please take a moment afterwards to send us an email. I'm more than happy to book a personal consultation. You can take this math that you've scribbled out on a piece of paper, scan it, email it to us, and I'm more than happy to arrange a personal consultation to walk you through to help you identify and do your own personal gap analysis. Because believe me, I absolutely believe with all my heart that the single most important thing for your family's financial future is to start with this process, identify the gap analysis, and then make sure that every decision you make from today moving forward is in alignment with the need, in alignment with the results you need from your real estate or any investment. In this example, for example, using the example we've been doing all along here, the result I would need from my real estate is $4,500 a month. Now when I go out there and I analyze different opportunities, I'm going to use the $4,500 a month as a target, a filter through which I make every investment decision, whether that's real estate or non-real estate. So hopefully every one of you right now have identified that number, done your gap analysis, and you have a number to work off of. So once you have that number, and now that you know your gap, my message is, don't panic. I know that some people are going, oh my God, that's way too high. You know, some of you are, you know what, for some of you, you realize the flip side, you realize, you know what, I don't have to go out there and buy 20 more properties. I just need to pay off the mortgages I have. And that is huge. If that's all you got from this webinar tonight, that's fantastic because it's critical. But for those of you who feel a sense of, oh my God, you know, I'm not sure how am I going to do this moving forward? You know, the one thing I always talk about is education overcomes fear. If you feel intimidated by any of this, don't worry. That's why we're here. The whole goal, the whole result of our whole purpose of this webinar series moving forward is to provide information and education. And like I said to you, in my role as the Vice President of TriView Capital, we have a ton of different opportunities. Invico is a diversified income fund. Prestige Capital invests in hotels. Centurion Apartment REIT is an amazing company. Prestigious Properties. Thomas Byers, some of you are familiar with his limited partnership company that invests in apartment buildings in Alberta, Western Canada. Rockspring is a fantastic player down in the United States. You know, Triumph Real Estate Investment Fund, they have some great American and Canadian investment opportunity. Centurion also has what's called a real estate opportunity trust, which is a unique company and product that invests in both real estate apartment buildings, but also lends money out in the form of private lending, which you as an investor can participate in. Quite a unique business model. One of my favorites, AP Capital, Alta Pacific MIC. Alta Pacific is a mortgage investment corporation that allows you to be the bank and get consistent 6 to 8% returns lending your money out in a pool that is protected. These are all different types. Regimen Partners, they have an incredible business model that allows people to participate in buying small, underperforming businesses, turning them around and creating significant profits and getting good, solid returns by optimizing and looking for great opportunities in buying businesses. And they've structured that in a limited partnership format that allows you to participate. Another one of my favorites, Clear Sky Capital. These guys identify some of the best real estate investment opportunities in the southern United States. They have a fantastic track record. Investors in that particular limited partnership virtually doubled their money in the last 3 years on their last exit. And again, whether they do that moving forward or not is another story. The point is this: we have access through, first of all, I want to just take a step back and let you know what private equity is, because we've talked about a lot of different things. But one of the big things that I want to emphasize is that through private equity allows an investor such as yourself to participate in non-publicly traded assets or investment opportunities that are basically pre-public stage. They're not liquid, and they have the ability to get great returns. They are considered high risk in some areas. So I know that a lot of people get pitched ideas all the time, and I'm not sitting here trying to pitch any idea to anybody, so I want to be very clear on that. But what we are going to do is we're going to be focusing on interviewing in subsequent future webinars. The webinar series is going to start in January. We're going to be interviewing various different companies like the ones on your screen right now. We're going to interview them, and I'm going to grill them with all the questions that you're going to want to know. And if you're interested in investing in the United States, in the southern states, we're going to talk to Clear Sky Capital and find out exactly why they do what they do, what makes them different, whether it makes sense or not makes sense. I'm going to be asking them the hard questions. We're going to be talking to Rockspring. We're going to be talking to Regimen. We're going to be talking to AP Mick. If you're interested in investing in mortgages, for example, we're going to teach you all about that. We're also going to be talking to, I don't have it up on the screen here, but we're going to be talking to Lonsdale Private Wealth. These guys are one of my favorites. These guys are part of the Newport Wealth Group, and they are actually going to be the first group that I interview. And if you have RSPs with Scotia McLeod, Dominion Securities, TD Waterhouse, Hollis Wealth, whoever you have your current RSPs with, I would absolutely say you want to plug into the webinar that when we have Newport and Lonsdale portfolio managers on, because when you listen to how these guys deal with the public markets and how they invest capital into the types of stocks and bonds and the allocation they allow to Canadian equities versus European equities versus private equity, it's quite fascinating. And I can't emphasize enough that they're one of my favorites to work with. And we're going to be launching with Lonsdale Portfolio with the Newport Private Wealth. We're going to be launching our first webinar in the new year with those guys. So I'm looking forward to, and trust me, I'm going to be asking these guys the hard questions, and you can send me your questions to grill them. We're not trying to sell anything, although if you're interested in investing in anything with these individuals, fantastic. But remember, regardless of whether you're interested in investing with them or not, you now have the filter. You can take the gap number that you've identified and then take investment opportunity, whether it's real estate, private equity, or the markets, and use your gap number as the filter through which you make your decisions. Because ultimately the goal here is to plan your future and live it on purpose. Folks, that is the end of today's webinar. I hope that made sense, and I hope you enjoyed it. I'm really looking forward to launching these interviews in the new year. I think it's going to be educational. I think it's going to be informative, and there's going to be some great investment opportunities for you in the process. So again, if you'd like to email me for a free consultation, just email to peter@peterkinch.com, and you can book a free consultation. There's my information on there, and that's it. If there's any other questions, please email me. Otherwise, thank you very much. I hope everyone on here has an absolutely fantastic Christmas and holiday season, and I'm looking forward to working with each and every one of you in the new year. Thanks very much, and have a great night.